When you come across a company for the first time, it's hard to know where to start. How can you evaluate a business in a few minutes to understand its performance?
So in this video, we are going to reveal 5 crucial numbers you must know when analyzing a company from scratch. Hey there, this is Stephanie Wong, tech industry veteran, engineer, and creator.
And I'm Bertrand Seguin. I'm the founder of App Economy Insights.
There are 3 major financial statements, and one of them is the income statement. It shows the profit or loss of a company, or P&L for short. We are going to focus on the income statement today.
In a previous video on our channel, we covered how to read an income statement for beginners. If you missed it, it's a great place to start.
Let's look at the largest company in the world, Apple, using their performance during the 12 months ending in September 2022, which was their fiscal year 2022.
So the first thing we want to analyze is the revenue, which is in gray on the left. It's the money earned from selling products or services. The first number you want to pay attention to is the revenue growth. It compares the revenue to the previous period. For example, if we look at the gray bar in the center, overall revenue grew 8% year over year. It tells us about the growth profile of a business and its maturity.
Note that a period is always affected by temporary factors. When positive, these factors are called tailwinds, such as launching a new product.
But when negative, these factors are called headwinds, such as inventory or supply chain challenges.
So you always want to keep that in mind before jumping to a conclusion.
It's critical to look at the revenue growth by business segment. We care about what the business can become tomorrow more than what it is today. For Apple, the main segment that's driving growth in the past few years at least has been services. As more people join Apple's ecosystem, they spend more money on digital services and apps.
All right, now let's turn to the next 3 crucial numbers to pay attention to, the margins. There are 3 margins you should know: gross, operating, and net margin. They are all expressed in percentage of revenue.
The gross margin is an excellent way to measure a company's earnings potential. It represents the percentage of each dollar of revenue the company retains as profits after the direct cost to deliver the product or services. The formula to calculating gross margin is gross profit divided by revenue. So a company with 50% gross margin means it keeps 50 cents on every dollar of revenue.
Apple had a 42% gross margin in FY22. Products, hardware like iPhones or AirPods, have a 36% gross margin. And then services, software like digital subscriptions, have a 72% gross margin. So Apple generates twice as much gross profit for every dollar spent on its services compared to the hardware lineup. So the products are a gateway to its digital ecosystem where margins are far superior.
Well, in the book Warren Buffett and the Interpretation of Financial Statements, we learned that Uncle Warren looks for businesses with at least 40% gross margin profile. Why? Because you can't offset the bad unit economics with volume. If the gross margin is low, there is no room for error. As a result, the sustainability of the business is at risk, and it shows a potential lack of pricing power or competitive advantage.
Next, we have the operating margin. It's a financial metric that shows a company's profitability after accounting for all of its expenses, except for taxes, interest, and extraordinary items. It's like the real profit a company makes from its operations after all of the bills have been paid. And the formula is operating profit divided by revenue. A high operating margin indicates a company's ability to generate profits and withstand competition. The margin trend over time is critical to see where the business is going.
So before we get to the last 2 crucial numbers, if you like this video, remember to like and comment below. This will help us be discovered and for us to bring more educational content to you for free.
Okay, next we have the net margin. It's the final profit a company gets to keep, net of taxes and other financial expenses. The formula is net income divided by revenue.
My focus is usually on the operating margin. Why? The net margin includes the impact of non-recurring items that can be misguiding, such as a legal dispute or maybe interest income. It doesn't say much about the long-term margin profile.
Finally, our 5th and final is the earnings per share, EPS. It shows how much profit a company makes for each share. It's calculated by dividing a company's net income by the number of shares outstanding.
The EPS can grow faster or slower than net income, depending on the number of shares outstanding at the end of a period. Watching the EPS over time is critical because that's ultimately what's moving the stock price.
So there you have it. You have learned the 5 crucial numbers to look for in a P&L. Are you ready to apply this to specific examples? We have 5 businesses with visuals for you to learn how to analyze a business and what to pay attention to in our next video.
Looking forward to that.